Okay, so we stopped from margin of sales. So what is margin of sales? Margin of sales units. So this is the difference between the expected number of units to be sold by a business organization and the break-even point in units. So if a particular organization is planning to sell a particular number of units in excess to the break-even point units, that gap between the break-even number of units and the expected number of units will give them a margin of safety. So within this margin of safety, they can earn profits. Okay. So how do we calculate this margin of safety? Expected number of units minus break-even point units. Okay. So margin of safety units. Another equation is profit divided by contribution. Okay. And yeah. And how do we calculate the sales value of this? Margin of safety units into selling price, or profit divided by PVR ratio. Okay. And another important concept is this expected profit. So number of units to be produced or sold to earn an expected level of profit. Okay. So target units, the equation is total fixed cost plus the expected profit divided by the unit contribution. And the sales value of this, we can directly get the sales value, total fixed cost plus the expected profit divided by PVR ratio. Okay. Yeah. And then let's have a look at this example. So the selling price is 200, total fixed cost is 16,000, variable cost is 60%. Sorry, VCR ratio, variable cost ratio is 60%. Number of units, 500 units. Calculate the break-even point in units and sales value. MOS in units and sales value, and number of units to be produced and its sales value to earn a profit of 60,000. Okay. So in order to calculate the break-even point of units, we need two components, total fixed cost and contribution per unit. So total fixed cost is given to us as 16,000. But contribution we are not given with. We have to compute the contribution per unit. So in order to compute the contribution per unit, we need variable cost and selling price. So selling price, yes, it's given to us directly. But variable cost is not given to us directly. So we have to find that variable cost. So we are given with the VCR ratio. So what is the formula for calculating VCR ratio? VC divided by selling price into 100. So by substituting this selling price and VCR ratio percentage, we can get the variable cost as 120. So using this variable cost, we can reach the unit contribution because we are given with the selling price. So the unit contribution will be 80. Using this unit contribution, we can then find the break-even number of units. Total fixed cost divided by contribution per unit. 16,000 over 80 is 200 units. So what is the sales value of this? 200 units into 200 of selling price here. 200 into 200, 40,000. Then how do we calculate the margin of safety? Margin of safety is the difference between expected number of units and the break-even number of units. Expected number of units is 500 and the break-even number of units is 200. Difference between these two is 300 units. So how do we reach the sales value of margin of safety? This 300 units into 200 of selling price, 60,000. So target units. So what is the number of units that we need to produce or sell in order to earn a profit of 60,000? So what is the formula? Total fixed cost plus the expected profit divided by the contribution. So total fixed cost is 16,000 plus 60,000 of profit divided by 80 will give you 950 units. Okay. So how do we compute the sales value of this? 950 into 200, which is 190,000. Okay. And yes, now let's focus how do we represent those numerical values in a graphical form. So graphical representation of break-even analysis. So for this, we can use three types of graphs: traditional break-even chart, contribution to break-even chart, and profit volume chart. Okay, so in the traditional break-even chart, we use the sales line, total cost line, and the fixed cost line on 3 lines. Using this, we can show the break-even point in units and break-even sales value. But a deficiency here is we do not use the variable cost line. So as a result, we can show the contribution in this graph. So this deficiency is overcome in this contribution to break-even chart. Okay. So here you can see this red line is the variable cost line. So as we are using this variable cost line, we can show the contribution here. Contribution is the difference between the sales line and the variable cost line. Okay. This part is the contribution. And also we can show the total fixed cost here. Total difference, the gap between the total cost line and the total variable cost line is the total fixed cost. Here the gap is a constant, meaning which total fixed cost is a constant amount. Okay. And then here this is the total profit volume chart. This negative values will show you the profit, and this positive values will show you the negative values will show you the loss, positive values will show you the profit. And here this point is a break-even point, no profit no loss situation. Okay. And then let's focus on the relationship between sales price and units with break-even point and profit. So a sales price and a sales units have a direct relationship with profit. Sales price, when we increase either the sales price or sales units, it will automatically increase our revenue, which will then increase our profits. Okay. But however, if we first focus on the sales price here, when we increase the sales price, what will happen to the break-even point in units? So what is the formula for calculating break-even point? Total fixed cost divided by contribution. How do we calculate the contribution? Selling price minus variable cost. So if we write the formula like this, total fixed cost divided by selling price minus variable cost. So now the selling price is a component within the denominator. So when we are increasing a component within the denominator means the answer will gradually decrease. That is the reason why break-even point in units are decreasing. So on the other hand, if we increase that selling price component in the denominator, our answer will, if we decrease that selling price component in the denominator, our answer will decrease. So there's a negative relationship between sales price and the break-even point in units. And there's no relationship between sales units and the break-even point in units and sales value. Okay. Yeah. So that's it for the discussion, and thank you.